Hi everybody. This is like this is the lecture for week 10, lecture 2. Supposed to be on Thursday, 31st of December 2020. This is like a replacement class. So I will continue with the thing that you have seen in the first lecture in week 10. So this is the last point that I have explained in the previous lecture. The thing is segment margin. So the term segment margin is an important term that you have to remember. Segment margin is the measure of the long run profitability of a segment. So segment margin means the profit made by a segment of a business. In the previous slide, you have seen that a business can have several segments. For example, a factory can have segment 1 that produce product A, and also segment B that produce product B. So how to measure the profitability of a segment? To measure the profitability of a segment, you have to calculate profit for that segment. That profit for that segment is called segment margin. So if somebody asks you what is a segment margin, so segment margin is the profit for one segment in a business. So you have seen in the previous slide, if you have a business that has several segments, you have to you can prepare an income statement for the whole business, and also a separate income statement for every segment of the business. So one of the things that is important when you prepare an income statement for a business that has many segments is the fixed cost has to be divided into two: traceable fixed cost and common fixed cost. But this is always a problem. There is always a problem to divide the fixed cost into common and traceable fixed cost. So these are several things that can happen to a business that has several segments. So the first one is omission of some costs in the assignment process. The second one is the use of inappropriate methods for allocating costs among segments. Number 3 is assignment of costs to segments that are really common costs of the entire organization. So let's see. So omission of costs. You have to just remember this. Costs assigned to a segment should include all costs attributable to that segment from the company's entire value chain. So when you want to calculate cost for one segment of a business, make sure you include all costs related to that segment to the company's entire value chain. These are the value chain. Value chain for a business. A business is started by research and development and product design, manufacturing, marketing, distribution, and customer service. So when you want to calculate cost for a segment of a business, make sure you include all these costs. If you miss one step in the value chain, then the cost allocation is not correct. Okay, this one. Inappropriate methods of allocating costs among segments. So this is also important. If you want to divide costs to several segments in a business, then you have to use correct method to allocate the cost. So see these figures or this picture. In a business, in this example, there are 4 segments. So failure to trace cost directly, arbitrarily dividing common costs among segments, inappropriate allocation based. So for a direct cost, it is easy. When a cost is a direct cost, you can trace the cost to different segment easily. You can see the relationship between the cost and the segment. But the problem is with the indirect cost, like overhead cost. When there are overhead costs, you have to allocate the overhead cost to different segments. So if you choose wrong methods to allocate the indirect cost to the segments, then things can go wrong. The profit or the segment margin will be wrong. Okay, so let's see the next one. Okay, this is very important. Remember this. When you have a business that has several segments, you have to divide the cost you have to divide the fixed cost into traceable fixed cost and common fixed cost. That is the way. You cannot allocate common fixed costs to different segments in a business. That is a very big mistake. Okay, you can see this point, the point that I have mentioned in this scenario. Okay, let's see here. Allocation of common cost. So this is a wrong thing to do. You cannot allocate common cost to segments in a business. So let's see. So there is a business. See here, Haglands Lakeshore. So this business has two segments, bar and restaurant. The correct way to prepare the income statement is like this. You prepare the income statement for the whole business, and then the fixed cost for the whole business has to be divided into traceable fixed cost and common fixed cost. This is the correct way. So in this income statement, you can see that the traceable fixed cost is 246,000. Traceable fixed cost means the fixed cost that can be traced to the segments in the business. So this traceable fixed cost, 26,000 is coming from bar and 220,000 is coming from restaurant. $200,000 is the common cost. Remember, common cost is the fixed cost that you cannot trace to different segments. So if you allocate this common cost to different segments, then there will be a problem in calculating the profit for every segment or the performance for every segment. So you will see. So remember this: bar, restaurant, bar making 14,000 profit, restaurant making 230,000 profit. Okay, let's see. Now, this is about the common fixed cost and traceable fixed cost. How much of the common fixed cost of 200,000 can be avoided by eliminating the bar? Remember, common fixed cost. What is the definition of common fixed cost? So always remember, a common fixed cost cannot be eliminated by dropping or closing one of the segments. Okay, remember that. Now, how much of the common fixed cost of 200,000 can be avoided by going out of the business entirely? So how much? So if the business exit the or stop its operation, then the 200,000 will be eliminated. That is the only event that can eliminate the common fixed cost. So the answer is all of it. If a common fixed cost can be eliminated if all the segments it supports are eliminated. If the business closed down, then the common fixed cost can be eliminated. If not, the common fixed cost will exist. Okay, so this scenario shows what happened if the business try to allocate or try to divide the $200,000 common fixed cost to the bar segment and restaurant segment. You will see what will happen. Suppose square feet is used as the basis for allocating common fixed cost of 200,000. How much will be allocated to the bar if the bar occupies 1,000 square feet and the restaurant 9,000 square feet? So, how much? Okay, the answer is A. YA 1,000 square feet over 10,000 square feet times 200,000. So 1 over 10 times 200,000. This is what happens if you allocate the common fixed cost. Okay, this is the thing that will happen. So if you allocate the common fixed cost, the allocation will be like this: 1 over 10. So you will allocate 25,000 the common cost to the bar and 175,000 to the restaurant. So let's see the previous question. 110 times 200,000. I think it's supposed to be 110, 1 over 10 times 200,000 supposed to be 20,000, isn't it? 20,000 and 180,000. So maybe the calculation here is not correct. But this shows if the business allocate common fixed cost to the bar segment and restaurant segment, you can see what will happen. So if the business allocate the common fixed cost, you will see that the bar segment is making loss. The restaurants is making profit, but the number of profit is smaller than the segment margin. So if you allocate common cost to different segments in the business, then maybe you are happy. Okay, everything is allocated. So, but the problem is when you allocate the common fixed cost to different segment in a business, maybe a profitable segment will become a segment that is making loss. So you can see here, bar, if before you allocate the common cost, the bar is making profit, 14,000 profit. But after you allocate the common fixed cost, the bar now is making loss. If you are a manager, and then maybe you think that it is good if the business close the bar, because the bar is making loss, so you have to close the segment that is making loss. So, but if, let's see what will happen if you close the bar. Should the bar be eliminated? The answer is, okay, let's see. The answer is actually no. If you close the bar, the total profit for the business is only 30,000. Remember, before the bar is closing, the total profit was 44,000. If you close the bar, then you are making a wrong decision. So this scenario shows that allocating common fixed cost to the segment those fixed cost support is a recipe for disaster. If you have a business, your business has several segments, do not allocate common fixed cost to the segments in the business. If you allocate the common fixed cost to the segment of the business, then maybe a profitable segment will become a loss segment, and then you close that segment. The results is the total profit for the whole business is lesser then before closing the 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 segment that is making loss. So if you allocate common fixed cost to segments in your business, then the thing that can happen is you make a wrong decision about the performance of segment, and maybe you close down a profitable segment actually. Okay, I hope you can follow that. The main idea, the main thing that the slide want to explain is common fixed costs cannot be allocated or divided into the segments. It is a wrong thing to do. Okay, so that is the thing. Always remember the point that I have mentioned in the previous slide. Okay, this is the second half of the chapter. Okay, so when you have a business and your business has several segments, and then there is a need to measure the performance of every segment in your business. If your business is a big business, then every segment will have a manager that manage that segment. So there is a need to measure the performance of the segment, and also to measure the performance of the manager who is responsible for that segment. When you want to measure the performance of a segment and maybe the manager of that segment, then there are several methods that can be used. The method that you have to know, or the methods that you have to learn in this chapter or topic is the first one is you have to know about return on investment. Return on investment is one method that you can use to measure the performance of a segment of a business, and also the performance of the manager of that segment. Okay, so how to use ROI to measure performance? So you have to use this formula. ROI, or return on investment, equal to net operating income divided by average operating asset. So what is net operating income? Net operating income is income or profit before interest and tax. Income or profit before interest and tax. Okay, so what is operating asset? Operating asset is cash, account receivable, inventory, plant and equipment, and other productive asset. So average operating asset means the beginning balance of the operating asset plus the ending balance of the operating asset divided by 2. That is why that is what we call as average. Beginning of the operating asset plus ending operating asset divided by 2. Okay, let's see here. They said there is a business, Regal Company, reports the following data. The net operating income of the business is 30,000. Average operating asset is 200,000. Sales is 500,000. So if you have to calculate the ROI, what is the ROI for this business? So ROI is the net operating income divided by the average operating asset. So see the calculation at the bottom of this slide. ROI equal to net operating income 30,000 divided by $200,000 average operating asset. So the answer is the ROI for this Regal Company is 15%. So ROI also can be calculated using this formula. ROI can be calculated as margin times turnover. So what is margin? So see the second box, the blue box. Margin is equal to net operating income divided by sales. Turnover equal to the gray or the brown box. So turnover equal to sales divided by average operating asset. So that's it. Okay, so ROI equal to margin times turnover. So ROI equal to net operating income divided by sales times sales divided by average operating asset. So if you use this formula, you can also calculate the ROI. In this example, ROI equal to 30,000 net operating income divided by $500,000 profit times $500,000 sales times $500,000 sales divided by 200,000 average operating asset. The answer is 15%. But the good thing about calculating ROI using this formula is you can see the way to improve the ROI. Okay, when you use the formula here, margin times turnover, and you can see the calculation for margin and turnover there. So you can see clearly there are three ways to increase the return on investment. First, you have to increase sales. If you increase the sales, then your profit will increase and your ROI will increase. So let's say in the future you are a manager in a segment of a business. So if you are a manager in a segment of a business, you know that your performance is seen through the profit made by your segment. The higher the profit made by your segment, then people will see that the better your performance. If the profit of your segment is low, then the simple conclusion that can be made is your performance as a manager of that segment is not good. So these are the three ways that can be used to improve the ROI of a segment. First, you have to increase the sales. When you increase the sales, the profit will increase. When you increase the profit, the ROI will become higher. Okay, second way to increase the ROI of a segment of a business is to reduce the expense. Okay, or cost. Reduce the expenses or cost. So if a segment's expenses decrease, the profit will increase. When the profit increases, the ROI will increase. Okay, the third way to improve the ROI is reduce asset. Remember the calculation, you can check the calculation or the formula. If you decrease the asset of a segment, the ROI will become higher, will increase. So these are the three ways to improve ROI. So let's say there is a question asked you. You are a manager of a segment of a business, and then your performance is assessed by looking at the ROI of the segment. Then the question asks you, what are the things that you can do to improve the ROI of your segment? So the answer is you can improve the ROI of a segment of a business by doing these three things: increase sales, reduce expenses, or reduce asset. Okay, see here. Controlling the rate of return. Regal's manager was able to increase sales to 600,000, which increased the operating income of 42,000, which increased net operating income to 42,000. There was no change in the average operating asset of the segment. So this is one example. This example or scenario shows to you that if you can increase sales, your ROI will increase. So the performance of your segment of business will increase. So let's see here, if the profit or operating income increase to 42,000, then what will happen to the ROI? Okay, so you put the 42,000 profit divided by sales of 600,000 times 600,000 divided by 200,000, average operating asset, the ROI will become 21%. So ROI increased from 15% to 21%. So good. So this is one way to increase the ROI. So if you are a manager in a segment of a business in the future, how one of the way you can use to increase the ROI of your segment is by increasing the sales. But there are several weaknesses of ROI. Okay, one, in the absence of balanced scorecard, management may not know how to increase ROI. I think you have learned about balanced scorecard in ACT3132, I think. So balanced scorecard shows what are the things that you can do to increase the profitability of a business. So this is one criticism or weakness of ROI. Second, managers often inherit many committed costs over which they have no control. So remember about this. If you want to assess the performance of a manager by looking at the manager's ROI, always aware that some costs are beyond the control of the manager. So there is a thing that in accounting that says you are responsible to things that you can control only. You cannot be asked to responsible for costs or the things that you cannot control. When you want to assess the performance of a manager, make sure you aware that he is responsible for the things that he can control only. Okay, number 3, managers evaluated on ROI may reject profitable investment opportunities. Remember, if about this, number 3 is also important point. If you are a manager in a segment of a business, let's say now your ROI is 20%. So you are very happy. ROI 20%. But let's say, and then you got a new project, or you receive a proposal to start a new project, and then the ROI of that project is 15%. 15% is still good, but your segment now is having 20% ROI. So will you accept the new proposal? If you the logic is you will not accept the new proposal, because if you accept the new proposal, your current ROI of 20% will decrease, because the new project is only has ROI of 15% only. So if you accept the new project, your ROI will decrease. So people can say that the performance of your segment are getting worse. So that is one weakness of ROI. Sometimes ROI can make managers reject profitable investment opportunities. I hope there is an example you can see for this point. So let's see. A division manager at Winston Incorporated. Okay, you are a division manager or a segment manager at Winston Incorporated. Your compensation package includes a salary plus bonus based on your division's ROI. The higher your ROI, the bigger your bonus. Okay, remember. The company requires ROI of 15% on all new investment. Your division has been producing an ROI of 30%. So you are very good. Your division has 30% ROI. you have an opportunity to invest in a new project that will produce an ROI of 25%. Okay, question. As a division manager, will you invest in this project? What do you think? Okay, the logic is you will not invest because now your division or segment has 30% ROI. If you invest in the new project, the ROI of your segment will decrease because the new project ROI is lower than the ROI that you have that you already have in for your segment. Okay, so I thought we are supposed to do what was the best for the company. As a division manager, I will not invest in that project because it will lower my pay. When the ROI decrease, your bonus will decrease. So you as a manager, logically, will not accept the new investment opportunity. Okay, I think I stop here. In the next lecture, I will explain about the second way or method that can be used to measure the performance of a business, the performance of a segment of a business. And also, it means that this second method can be used to measure the performance of the manager of that segment of the business. Thank you very much. Do not forget to write your name and metric number in the comment section. I will take it as your attendance for the lecture.